touch the open. I'm Lisa Abramowitz in for Jonathan Farrow. Moments away from the start of the trading, that lift persisting into the open. NASDAQ up 0.8%. The S&P up about 0.7%. You can see the Russell really leading the charge with small caps getting that bid in. We are seeing over in the yield space, yields in, and you can see the dollar a bit weaker. Stocks up, yields in, dollar stronger. Some perhaps a retracement of what we've seen in the oil space. And this is something that we keep talking about as we forward ahead to a time when perhaps we're moving more to stock picking and less to overall indexing. You can see crude $73.20. One stock that we're watching at the open is Airbnb. Shares sliding after the company delivered a weaker than expected outlook as the post-COVID travel rush loses steam. Bloomberg's Abigail Doolittle is back with us for more. Abigail.
And for a brief moment this morning on the open, which is just a matter of seconds, the stock was having its worst day ever since IPOing in 2020. Now looking at the worst day since November of last year. And what makes it so interesting, the first quarter that they reported was really pretty strong. They put up 20% revenue growth for $1.82 billion in revenue, Airbnb's best first quarter ever, as the pandemic trends continue to play through of people wanting to get back out there, working from home, creating those longer weekends. But it's that second quarter that you were talking about, Lisa, that has the stock down so much. The idea that some of these trends are muted. They're now looking for growth of 12 to 16%. So if you consider back in the fourth quarter of 2021, when revenue growth was closer to 80%, the last quarter, this first quarter, 20%. Now we're looking at somewhere between 12 to 16%. Investors want more growth. Now, when Brian Chesky, the CEO, last week joined us on Bloomberg Television, he was talking about the idea that if the economic uncertainty were to lift, that would help out. So perhaps some of that uncertainty will lift, although based on all of the headlines and the data that we're receiving, even given the fact that CPI print right now is in line, it's unclear, funny enough, whether or not the uncertainty will lift. So right now, this stock under pressure because of those lower growth expectations and travel expectations on the part of consumers.
Abigail, thank you so much. Sticking with earnings, Wynn Resorts posting a record quarter driven by a surge in business from Las Vegas. The CEO writing, quote, "Each of our resorts is generating strong financial results, a testament to our team's relentless focus on delivering five-star hospitality and experiences to our guests." Bloomberg's Katie Greifeld joining us now. And this really is the tale of two hospitality companies. Airbnb seeing really potentially negative trends there, but you see that positive kind of tone from Wynn. Katie, is this just a market-specific thing, or is this a very company-specific thing?
Looking like it's a little bit more company-specific, but I will say, even though it was a big quarter for Wynn, you wouldn't know it by looking at the shares this morning, currently down about 1%, even though, I mean, first quarter adjusted EPS, it clocked in at 29 cents. Analysts were expecting a loss, actually, of 9.2 cents, so a big beat there. Operating revenue also coming in better than expected, as did most of its occupancy stats. You brought up Las Vegas. Let's also talk about Macau. Hotel occupancy there was nearly 91% versus estimates of just 53%. You saw at least 3 analysts raise their price targets in the wake of these numbers, but still, even though Wynn was higher pre-market, we're looking at a little bit of a loss here as trading kicks off.
Katie, thank you so much for that. Turning now to the automakers, Rivian reporting a smaller than expected loss and reaffirmed plans to boost production, writing in a statement, quote, "While challenges remain, we have become a stronger, more agile company through this process." Joining us now is Bloomberg's David Welch in Detroit. David, how much of this is a story of just simply surviving a David versus the Goliath that is Tesla?
Oh, it kind of is. I mean, look, it's smaller than expected loss, but they also spent less on CapEx, and they've been cost cutting. So it's not like the company is posting huge sales, but they are hanging in there. Cash balance over $11 billion in an environment where it's very tough to raise capital. That's a good sign. The biggest thing I think investors are reacting to in aftermarket yesterday and pre-market trading this morning is they're on target to deliver 50,000 vehicles. While that doesn't sound huge, you look at General Motors, they're going to deliver 70,000 of their new Ultium-based electric vehicles. So that's a pretty good number. And it's always been a problem for whether it's legacy automakers or startups getting EVs produced, getting them out the door. So they're getting production up. Long term, though, they're still going to have to afford to develop new models and boost production. A lot of that costs a lot of money. So when they say there are challenges ahead, there certainly are.
David Welch, thank you so much for that. Stocks are higher for the third time in the past 4 sessions. Lafayette's Krishna Memani saying equities aren't a bad place to be.
In any tightening cycle, There's only one theme that lasts throughout the whole thing. And this go around, it's simple. Nominal growth is quite strong. It's coming down. It hasn't come down enough. And inflation was quite high. It is coming down. It hasn't come down enough. That's the regime that is going to be in place. And that's really not a bad regime for equity markets.
Well, perhaps not in the long term. Short term, however, SoFi's Liz Young telling investors to stay cautious, embrace for volatility. Liz joins us now. Liz, is that really where you start with? Basically, long term, maybe yes, but short term, it's going to be pretty rocky.
Yeah, I mean, for any long-term investor, you do have to have equities in the portfolio, and I'd be hard-pressed to find a time in my career where I would say that you don't have equities in the portfolio. However, we are in a period where there's a lot of signals going off that we're still late cycle in the economic behavior that's going on, which would tell you that if we do approach a recession later this year, markets rarely tend to bottom before the recession. So even if we have to retest some of those lows, it would tell me that there's volatility that's more likely than not. I think what investors are grappling with, self-included, is that there hasn't been a ton of volatility this year already, even though we know all of this data. I think it's important that CPI is cooling, and I'm optimistic about the report today. And one of the questions that I get pretty often is, what would turn you from cautious to more optimistic? And the answer is always, if services inflation comes down. And it has shown signs of weakening. I think we are on the right path. It's a matter of, do we get to the goal before something else breaks? And I'm not sure that that's something that we're going to see happen in the next 6 months or so.
Let's build on that. Morgan Stanley's Ellen Zentner seeing a potential Fed pivot, writing, quote, a slight increase in core inflation with significant deceleration on core services should encourage the Fed to keep the door open for a June hike. We continue to see the data and financial conditions firmly supporting a pause in June. Is that your view, too? That basically this is green lighting a pause, the CPI data that we just got, and really just confirms some of the rate cuts that are being fully priced into the market now by September?
Yeah, look, the Federal Reserve doesn't call me for my opinion, and I know that they're doing a lot of different analysis on everything that they see out there. I think that they could justify a pause, and frankly, I think they could have justified a pause last time. It's a matter more of, do they want to stay consistent on their narrative that they wanted to get to a sufficiently restrictive level and then hold rates at that restrictive level for an extended period of time until the inflation problem is taken care of. We are sufficiently restrictive, in my opinion, and you can measure that a number of different ways. If you look at it as Fed funds rate above the 10-year Treasury, we can check that box. If you look at it as Fed funds rate above inflation, we can more or less check that box, as long as you're not looking at core CPI. But if you're using their measure of PCE, Fed funds rate is above that. So we're restrictive. They could pause here and use that as the explanation. They're seeing some cooling in the data. We think rates are restrictive enough. We want to wait for those long and variable legs to work their way through the economy. I think that's probably a fair statement to make. Frankly, I don't know how much of a difference 25 basis points makes at this point. I think what they probably have tried to avoid was too much of a rally or too much of a natural easing in financial conditions just because they paused. And there still continues to be this big disconnect between what the Fed is telling us they're going to do and what the market thinks they'll actually be able to do. One of them is going to be wrong by the end of the year, and we're going to have to see those expectations come closer to in line late summer, early fall.
Liz, you pointed to the idea of something breaking and how it's too soon to say that it's all clear in terms of a real financial market fissure or some other development that really calls the market's hand in a more significant way. Where is your focus in terms of the catalyst? Is it still on the regional banks? Is it on commercial real estate? Is it on private credit and debt markets that we have continued to see blossom, and people say that they're in a golden spot? How much are you looking at specific markets to understand the next shoe to drop?
Well, I think everything that you just named is not mutually exclusive, and I think it's all indicative of a tightening credit and tightening availability of funds. And just on a very simple level, if you take a bunch of funds and a bunch of movement of money out of the economy, there's going to be contractionary feels about it, right? There's going to be less money that moves around for consumers, less money that moves around for businesses. I think what's happening right now that we don't hear about or talk about very much to regular investors is that you're seeing a tightening of credit to small and mid-sized businesses. If those businesses are not publicly traded, or if we're not hearing about it from the companies that are tightening that credit, we're probably not getting the full picture. So I think that there are some stresses bubbling under the surface that just haven't quite made their way into the general narrative that we're seeing in publicly traded equities, for example. But there is definitely a tightening going on, and tightening in lending standards that's going to be experienced over the next 2 to 3 months. The question is, does that then translate into higher default rates? Does that then translate into what affects the consumer and consumer lending? Those are the questions that are not answered yet, but I do think we're going to see some stress that comes more into the mainstream from that tightening of credit, and that's where my focus is.
What's the best place to express that stress, given that a lot of people are expecting some sort of catalyst? A lot of people are staying away from certain equities and hiding in bonds.
Well, if you look at corporate bonds, some of the spreads are still too tight, in my opinion. I think you want to be careful not to get too optimistic on high-yield bond spreads or even investment-grade bond spreads, particularly in that triple B space, because if we do see credit stress, we're likely to see those spreads blow out a little bit more than what we've seen so far. So in equities, I still would be cautious, and I still would be looking at things like defensive sectors, although they're overpriced, but you want to be careful not to be overly exposed in this environment to things that would take it on the chin in a cyclical downturn. We've obviously already seen financials take it on the chin quite a bit. That doesn't mean that's over, but they have experienced quite a bit of a drawdown already. If you look at other things like industrials, even consumer discretionary to some degree, if we see this hit the consumer, you want to be careful in those places too. I still like short-term bonds. I think that these yields are really attractive, and they're yields that we haven't seen in such a long time and may not see again for a very long time. So I like that as a space. I like gold, even though it's hovering around all-time highs. I think it's there for a reason, and as the dollar weakens and we continue to see monetary policy change around the globe, I think gold is going to continue to catch a bid.
Liz Young, thank you so much for being with us. And just sort of to build on some of the caution, UAE's Royal Group shorts U.S. stocks, just coming out and saying that an investment firm controlled by a top Abu Dhabi royal has gone short U.S. stocks as it prepares for a recession. Coming up, the banks back in focus.
The Fed basically made interest rates very low for a very long time. They flooded the banking system with deposits. Some banks took those deposits and bought long-dated assets. That didn't work out for them. So the Federal Reserve's monetary policy did contribute to the problems that we've seen in the banking sector.
First Citizens providing some optimism. We'll take a closer look at some of the regionals with CFRA's Alexander Yoakum.
Fed missed what was going to happen in the banking sector. If you look back at the November financial stability report, there was nothing about the potential funding risk of regional banks. There was nothing about the large mark-to-market losses on their balance sheet. There was nothing about the risk that uninsured depositors might leave. So the Fed really, didn't capture that. And I give the Fed a lot of credit for the report that they published just recently on what went wrong with Silicon Valley Bank. I think they do recognize their supervisory failures, but that's not sufficient.
First Citizens giving the banking sector a dose of optimism, at least this morning. Deposits topping $140 billion in the wake of its rescue deal for Silicon Valley Bank. That acquisition adding nearly $10 billion to their net income. The CEO giving investors a bit of confidence, saying, quote, "We continue to operate with solid capital and liquidity positions." For more diving in is Katie Greifeld of Bloomberg, who is back with us. Katie.
Well, this was really fascinating because this was really the first look that we got at how First Citizens is faring after that rescue deal for Silicon Valley Bank back in late March. And so far, it looks pretty good. You can see that in the shares this morning. Like you said, First Citizens said that its deposits totaled $140 billion in the first 3 months of the year. Analysts, for context, were expecting about $119 billion. The SVB acquisition also added $9.8 billion in preliminary gains to its net income and about $850 million in net interest income to First Citizens first quarter. Now remember, First Citizens bought about $72 billion of SVB's assets at a big discount of about $16.5 billion. That's been a big boom for shares, as you can see that line in white there. They've just about doubled over the past 2 months, definitely adding to those gains today. Shares currently up about 9% or so.
Katie Greifeld, thank you so much. This hasn't necessarily brightened the optimism more broadly. CFRA's Alexander Yoakum painting an ugly picture of the sentiment surrounding regional banks, writing, quote, "Since the collapse of SVB, investors have been looking for the reasons to sell regional banks rather than reasons to buy them. We expect a meaningful decline in profitability for regional banks in Q2. Alexander, I am pleased to say, joins us right now. Is this really just a question, Alexander, of profitability, or is this a broader existential threat to their existence as smaller institutions at a time of rapidly rising rates?
Yeah, I think for most banks it is just profitability. I think regional banks do serve an important purpose. You have to remember that smaller businesses really do prefer the regional banks. They have more customized services that they like. But yeah, I mean, profitability is going to be tough with rising funding costs and slowing loan growth. Profitability is going to be tough in Q2 and probably in the third and fourth quarter as well.
What's the response to it, Alexander, and what's the barrier to have a greater wave of consolidation that a lot of people are calling for?
Yeah, I mean, in terms of consolidation, we do expect some consolidation going forward. Especially for banks with excess deposits, we think they're going to be attractive. But like I said earlier, I mean, I do think banks of all sizes serve a purpose, and the U.S. is a little bit unique in that aspect, and I think that's a good thing, not a bad thing.
So, given the fact that they've been under pressure, Alexander, what's the read-through in terms of credit tightening that people are expecting, even if we're not yet seeing it in the Senior Loan Officer Opinion Survey?
Yeah, so in terms of loans and credit, we do expect loan growth to come down, especially for regional banks. Banks with deposit outflows, we expect them to have even more, loan contraction. Business probably a little bit more than consumer. In terms of credit quality, credit quality is still very strong. The average regional bank, their credit quality is still a third stronger than it was pre-pandemic, and it's only 10%, so only 10% of loans are going bad compared to the great financial crisis. So in terms of credit quality, things are quite strong, but loan growth we do expect to slow down.
Do you have your eye on any banks that have particularly high concentrations of office-related commercial real estate, other assets that you think aren't properly hedged? Do you think that there are those other shoes to drop, or do you think people got ahead of themselves as they tried to play roulette with the regional banking wheel?
Yeah, I think they might have actually gotten a little ahead of themselves. You'll notice banks that do have high commercial real estate exposure actually did perform pretty well in the first quarter. What typically happens is, recessions are a surprise, and banks don't have time to react. But in this case, banks have been talking about a recession, for a year now. So they've had, generally time to prepare for this. They've increased their provisions for loan losses. They've increased their capital. So although credit quality will likely get worse, we actually think a majority of banks have prepared pretty well for that.
Do you feel like perhaps we're getting closer to a bid in this sector, or do you think that that's way too soon just simply because sentiment is driving the bus?
Yeah, so sentiment is driving the bus, but the positive is, I've only heard, negative headlines for the last month or so. So if we do start to get some more positive, results or news, I wouldn't be surprised if there was a pretty sharp rally. Whenever everybody is on the same side of the boat, if it flips, it could be a pretty quick surge. We saw a little bit of that with PacWest already, but I wouldn't be surprised if the whole industry, had a pretty good run on a positive news.
Just real quick, Alexander, what's your buy list, or what's on your buy list if that happens?
Yeah, so we definitely think that owning all regional banks right now is a little dangerous, just because banks that do have high levels of uninsured deposits or deposit outflows, there's concern there. But we think a name like PNC, which is actually the sixth largest bank in the U.S., is very well positioned. They've been grouped in a little bit with some of the other regional banks, but they actually didn't have deposit outflows in the first quarter. Over half of their deposits are insured, and they're very well diversified by geography. But they've sold off versus, the larger banks, which are largely flat. So we think that's a little bit unfair on them. And then Fifth Third is another one that we really like. A little bit of a smaller name, kind of a classic regional bank there. But again, they didn't really see deposit outflows in the first quarter, almost 50% between consumer and commercial, well diversified. Both of those banks didn't really see net interest margin contraction, wasn't too substantial there. And, considering they've sold off pretty significantly, we think if they kind of perform as a little bit status quo, they'll likely outperform.
Alexander Yoakum, thank you so much for that. Let's take a look at some of the sector price action this morning and head over to Bloomberg's Abigail Doolittle. Abby.
And it's interesting, Lisa, because earlier on that CPI print, that inline CPI print, we had been looking at a gain of almost 1% for the S&P 500, now up just slightly. Just a few of the sectors higher. In particular, we have communication services, technology, and discretionary higher, but utilities leading the way up 0.8%. This is yields go lower, makes those dividends look more attractive. That's the case over the last week, too. Now, most sectors over the last 5 days are higher, but you'll note that two of these yield-sensitive, dividend-sensitive sectors, real estate and utilities, are sharply higher, and the financials, which could benefit from the idea that yields are going higher, well, today, obviously, they're going lower, up about 0.5% as well. But it's interesting to see investors paying attention to this, for sure.
Very much so, Abigail. Thank you so much. Coming up, the market-moving events that you need to be watched. That's next in our trading diary, as we do see that pop throughout markets more broadly. This is Bloomberg.
Jobs Day, like Bloomberg.
This is Bloomberg's The Open. I'm Lisa Abramowitz for Jonathan Farrow. Taking a look at markets, you are seeing that pop. We are going to be watching that throughout the day. The trading diary, what you need to be watching this week, the House Financial Services Committee holding a hearing on recent bank failures. That's at the top of the hour. President Biden discussing the debt ceiling at 1:30 Eastern. Tomorrow we'll get another U.S. PPI, another read on inflation, as well as, of course, jobless claims. And we round the week on Friday with more Fed speak. Jefferson, Bullard, and Daly all on deck. Plus, President Biden and congressional leaders once again meeting to talk about the debt limit. Right now, what we are seeing, NASDAQ up 0.7%, basically pulling back a little bit from earlier gains. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Wednesday, May 10th. Here are the top market stories we are following for you at this hour. CPI, nothing to see here. Super core falls. Headline comes in with estimates. Markets take it as dovish. We're going to find the takeaway. And golden age for credit. We're going to talk to Bruce Richards of Marathon Asset Management on how much dry powder he's ready to invest in the private credit market. And the unthinkable. Wall Street leaders warn of long-term implications if the U.S. doesn't pay its bills. The cost of insuring against U.S. debt default soars. We're going to dive into some of those hedges. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. So the market definitely seemed to take that CPI as dovish. I don't know if that's actually the right interpretation. It feels like a choose-your-own adventure at this point.
Absolutely. Can I just say that first headline, genius, nothing to see here. I think if you'd spelt it just C, it would have been amazing. But that maybe should have been our question of the day.
I thought you were mocking me because that's what happened. So I was like, you can't be giving me a compliment.
I'm mocking you, but in the same time giving you a compliment. Doesn't happen often. This is a rare occurrence. Yeah, I think so. Look, here's the way I'm looking at it. The number really didn't change anything. I think at the margin it may have been slightly dovish, but not much. It's no reason for the Fed to hike anymore. It doesn't seem to be a reason for the Fed to cut. But I thought that's where we already were.
Yeah, but did someone tell that to the bond market? Because the bond market seems to be pricing in something different.
The bond market is definitely pricing in cuts. But increasingly, I would say the narrative is moving against the bond market. Certainly, there have been more and more high-profile strategists out over the last few days suggesting that cuts this year are unlikely. But our question of the day, which should have been nothing to see here, but we weren't that clever, did the inflation print change anything? Let's try and answer that question. Mike McKee's in the studio. Liz McCormick joins us down the line. Liz, I'm going to start with you. Did that print change anything?
Well, I think even though, like you're saying, there's nothing to see here, I think for the market it was, I can't tell you how many strategist notes I've seen that says it was a sigh of relief, you know? It wasn't enough. The market is like, you're going to have to show me, prove to me there's any reason for the Fed to hike in June. And this number definitely wasn't that. Clearly, like you said, the economists, it's still higher than the Fed wants. But listen, we got a, call it like market speak, a four handle on inflation, the headline, for the first time in 2 years. So that was welcome, 4.9. And like I said, I think it was enough for the angst in the market to ease that they're, kind of pricing away, though there's more data to come, that risks of a hike in June just got really tamped down to, really below 10%. Mm-hmm. And like you said, they're pricing cuts. That's another question we could talk about. I'm sure we will.
So then to that point, did we learn anything? Like, okay, so maybe, Mike, this takes it off the table for a hike in June, but did it price in more hikes? Was that a legitimate takeaway?
That's not a legitimate takeaway either. One thing you have to keep in mind is that there is going to be another CPI report before the next Fed meeting, and there'll also be a PCE inflation report. So we will see if this is a trend, if this is a one-month aberration where we don't see much happen, or whether we're going to see inflation start to come back down more dramatically because we see some of the rent price inflation start to finally fall out of the numbers.
But Alex, you can't take this number in isolation either. You have to look at it in the context of the payroll report we just got and all of the other data we are getting. Is the totality of the data, to use Fed speak, enough to generate a reason to cut? And you put this CPI report next to the employment report from Friday, and it still paints a fairly positive picture for the US economy. This is an economy that is slowing down, but just not very quickly.
Yeah, and also, if we dig inside a little bit to these numbers, there were signs that the good disinflation that we saw is reversing a touch, like in the used car prices. Mike, what'd you make of that?
Well, things are going to go up and things are going to go down. The used car prices on a wholesale level have already started to fall again. So in coming months, we'll probably see that reverse. Different categories will go up and down at different times, as you know, from covering the oil and gasoline markets. I think that the key thing here is that the Fed does not have to respond to this particular report or this jobs report, because we will get another one of those as well. The economy is still strong, but it's not so strong that they have to raise rates. And I think that's the point that Liz was getting at. We're not seeing at this point any reason the Fed has to raise rates. We're not seeing any reason they're going to cut rates either.
Yeah, and that's the point, Liz. You brought it up earlier, so let's talk about it. Where is the evidence at this point? And I appreciate that people are looking at what is happening with financial conditions, looking at what's happening on the credit side and extrapolating and saying, at some point credit conditions are going to tighten to the point at which we do get a recession. But are the data that we have at the moment consistent with a cut?
Yeah, no, I totally agree with you, Guy. The data isn't consistent with a cut, right? And if we all threw $1 in to bet, I'd probably bet the Fed, stays on hold all year. That said, markets and traders have to price in risks, right? So like you said, they're pricing in, we're still finding out what's the hit from the tightening financial conditions from the banking sector. Is it over yet, the problems we saw in regional banks? We also, like you mentioned in your intro, we have this looming terrible debt ceiling angst we're facing again, which, we had a meeting yesterday in Washington. There's another one Friday. And that you have to, there's risks that we kind of get over this X date. Hopefully we don't have a default, but markets are pricing in that. And maybe the Fed has to lean in if the economy implodes from a default. So I think, like you said, the data doesn't quite back it, but traders are saying, I don't know, maybe we get a hard landing or all these other tail risks. We're just going to lean into the cuts for now. Show us to make us change our mind.
Yeah, I feel like they've shown them, though. I think the Fed's been very clear, and yet it still doesn't seem to do any good. Liz, I guess another question that I wind up having then is, do we need to start looking at the debt default issue in relation to how markets are going to move? In that I appreciate that the headline came out and all of a sudden we saw buying come in, but is the Treasury going to weirdly be a safe haven as we get closer to that X date, particularly on the back end? So can we really look at the bond market for clear indication of how we feel about the Fed?
Well, I think, like we saw in 2011 when we had the downgrade, Treasuries actually rallied. And like you said, the long end especially, because the front end has the weird dynamics about the X date. So I don't think we're there yet, Alex. I think, what the long end did today is more about the CPI, like we said, not being too hot. They were happy. But I think as we get closer, which is not too far away, Secretary Yellen said it could be, start of June that the X date is, that you're going to see some safe haven buying and some fear. They're avoiding the short end Treasury bills that could be in the default zone, but that you might kind of lean into safe assets like Treasuries.
I don't know, Guy. That's sounding a lot like the G word, Goldilocks.
This was Alex's other question of the day.
It was.
Is this Goldilocks? I can't think of how you could have Goldilocks with inflation, let's call it circa 5%, with a labour market that is still relatively hot, with an NFIB survey that is pointing to the fact that small businesses are still struggling to hire people, and that is continuing to be one of their major concerns. There are plenty of bits of this economy that still feel tight. The banking issue is one that I think is hard to quantify at this point. And I think that is something that I think only time will tell. Mike, this is, if it's not Goldilocks, what is it? And I'm wondering what the current scenario is, and what would the scenario have to look like for the Fed to cut? If this isn't the data you're looking for, what is the data that we will be looking for to get the Fed to cut?
Well, we are still, I think, with Mama Bear's bowl that's too hot rather than Goldilocks. However, I think that what the Fed would be looking at would be some sort of collapse in the economy or some sort of huge jump in unemployment in a very short period of time. Those might lead the Fed to rethink what they're doing. But other than that, they're not going to, except for the possibility of the exogenous shock that could come from a debt ceiling issue. I mean, if we got a default, or if we even came so close that it roiled the markets, then we wouldn't be talking about CPI anyway.
Guys, thanks a lot. We really appreciate it. Liz and Mike, great way to set up the next 2 hours for us. And speaking of, on Friday, we're going to have an interview with U.S. Treasury Secretary Janet Yellen from the G7 finance ministers meeting in Japan. That will be live at 8:30 a.m. UK time. You definitely want to wake up to check that out. All right, coming up, more on our question of the day. Did the inflation print change anything? Julian Emanuel, Evercore ISI Chief Equity and Quant Strategist, is next. This is Bloomberg.
tomorrow. Bloomberg continues its coverage of the J.P. Morgan Global Markets Conference in Paris with an exclusive interview with J.P. Morgan CEO Jamie Dimon in the wake of the bank's purchase of First Republic. Join Francine Lacroix at 8:15 a.m. Eastern as they discuss the banking crisis, taming inflation, jobs, and more. It's all happening live on Bloomberg Television and Radio, your global business authority.
The Fed's making some progress on the inflation front, but they haven't made much progress yet on the labor market and on the wage trend. So it's hard to see inflation going all the way back to 2% with the labor market this tight and wages this high. They're going to keep rates at this level or maybe even a little bit higher until they see signs that they're confident that inflation is going to get back to 2%.
That was New York Fed President Bill Dudley on Bloomberg TV earlier. I want to circle back to the question of the day. Did the inflation print change anything? Joining us now, Julian Emanuel, Evercore ISI Chief Equity and Quant Strategist. Julian, did it?
No.
No, okay. So why is the bar market moving?
Look, this reaction today to us is basically investors who were late to getting the memo that the Fed is pausing. We think that memo started circulating when the rally started a week after Silicon Valley Bank in March. And for us, this is in the price, largely.
Julian, that's great, but the market, the equity market's looking at the bond market, and the bond market's saying we're going to get cuts. But this data doesn't exactly scream cuts either. So why would the equity market go up if this data doesn't scream cuts? At some point soon, particularly for the big mega cap tech stocks, there needs to be a validation of the idea that we're going to get imminent cuts.
And actually, Guy, this is a be careful what you wish for, because in our view, the only way you're going to get imminent cuts is if you have renewed stress because of the banking situation or some sort of new stress because of the debt ceiling. That's not our base case. Default is not our base case. But if you see that kind of stress, that's where you get cuts. And the only time you've gotten cuts within a couple of or 3 months after the last hike were in years like 1987 and 1974.
Which is also puzzling why the VIX is so low and why the S&P is still trading near 4,200, because those two things don't match up. Okay, so what do we know then? I mean, what falls first?
So to us, again, the immediacy of the debt ceiling makes it likely that the next major move in the indices is towards a test of the 3,800 floor. You know, again, we've been going between 3,800 and 4,200 for 7 solid months now. Nothing has happened, despite the fact that everything has happened. And within that context, we think volatility is too cheap.
Okay, so in that scenario, Julian, you're short into the X date and long out of the X date. Is that the right trade for equities right now?
Well, I think you have to think about the X date within the context. Look, even if they solve it or kick it down the road a couple months with a stopgap measure, the reality is that a lot of the data behind the scenes, leading economic indicators, sentiment measures, and so on and so forth, within the context of inflation still being relatively sticky, tell you that a slowdown is coming. And so that is likely means for us increased caution, even if we are successful with the debt ceiling.
Okay, so if we wind up seeing a recession coming, okay, what do companies do? Do they sacrifice margins to help their sales, or do they protect their margins? Because that's going to have the inflation feed through.
So the actual surprise about earnings season so far, and this has supported the market broadly, is that margins have gotten better.
Yes.
To everyone's surprise, ours included. And basically what that is two things. Number one, the cost cuts from the layoffs that we've seen, particularly among the technology companies, is certainly helping. And then to a certain extent, it's not a great extent, but to a certain extent, commodity input costs have fallen.
Given all of that, what am I doing in terms of positioning right now? How do I position for a Fed that doesn't cut until the end of the year or into next year? How do I position for the debt ceiling? How do I position for an earnings season that is, as you say, going surprisingly well, and maybe companies are taking advantage of the consumer, but the consumer is okay with it? How do I position? That's quite the mix, Julian. How do I position around it?
It's a complex mix, no doubt. Look, from our point of view, the skew is defensive, obviously, for the reasons that we've enumerated. You want to stay towards healthcare. Biotech in particular actually has defensive properties. It is a proven performer in and around Fed pauses, which we think we are certainly at one. Consumer staples, we think, is going to maintain both its top and bottom line into a slowdown. And look, we have been outperform rated on energy for over a year now. It's the only sector that's actually already pricing in the recession that we think we're going to get. And there is not only an OPEC put, but I would suggest that there's a short call that the U.S. government has with respect to its need to eventually refill the strategic petroleum reserve.
So there'll be some kind of support for the oil price.
Yep.
Hey, Guy, here's a breaking headline for you. Some ECB officials starting to think that the September rate hike may be needed. So think of a scenario where we're pricing in cuts from the Fed and the ECB is still hiking in September.
Yeah, Bank of England maybe as well. I find it hard to believe that if the Fed's in a position where it's nearly cutting, the ECB can still be in a position where it is still hiking. I appreciate that the ECB started late, but we'll see what happens there. But there is also this argument as well, which says that the longer you talk about hikes, you don't have to do the cuts. And I do wonder whether there's something kind of in that for when the Fed is communicating. Julian, that's the point. At this point, is the Fed really ready to be talking about cuts at this stage? And the way that it kind of camouflages what it sees going on, because it doesn't want to do anything because it doesn't know yet, is to still be talking about a balanced risk probability of hikes versus cuts. How do you read the communication right now?
No, I mean, if you go back to last week's presser, he did everything he could do, Powell, to take the concept of cuts off the table. He does not want to make the Burns blunder of 1974.
Well, exactly.
Yeah. Julian, we love it. Thank you so much. So good to see you. Julian Emanuel of Evercore ISI. This is Bloomberg.
Great questions.
All right, Honeywell stock is fading some earlier gains today. The company announcing a deal to provide technology that produces green, sustainable aviation fuel to HIF Global that will use that technology in a new U.S. e-fuel plant. It's worth a second to explain how all this stuff is made. Okay, here's the deal. You take water and you use wind or solar energy to separate the water, and you take the H2, the hydrogen from that, and you mix it with carbon dioxide that you're sucking down from the air. Then it goes to a plant, it makes e-methanol, and the e-methanol goes on to make e-fuels. And this is the part where Honeywell's technology really comes into play. Honeywell says that this new technology that they call e-fining can actually reduce greenhouse gas emissions by 88% versus conventional jet fuel. So Guy and I caught up with the CEO of Honeywell Performance Materials and Technology, Lucien Bodea, and asked him about the promise of e-fuel.
When you think about e-fuel at this point, it's the more expensive alternative. But it's also the ultimate solution because basically the feedstock to e-fuel, it couldn't get any better. You're capturing the CO2 from emissions and you're using water and green electricity. So that's about as clean as you can possibly get, reducing 88% of greenhouse gas. That's the highest cost solution today. I would put that at multiples of conventional fuel, whether it's 3 times, 4 times, but it's in that range. And then SAF, normal SAF, if you wish, that might be 2 to 3 times. So that's where we are. That's not with any incentives. Once you put incentives in place, you start narrowing that gap as well. But then when you convert that into a per ticket price, it doesn't really change dramatically the equation of choosing to fly on a plane. And when you add to that reducing greenhouse gas emissions by 88%, it becomes very compelling.
Lucien, good morning. It's Guy. Last time I checked, the numbers were daunting in terms of the scale required to get airlines to their 2050 targets. The number I pulled out was 17.5 billion gallons of sustainable aviation fuel are going to be required by 2050. How far away are we currently from achieving that kind of scale, and how quickly can your kind of technology get to that kind of scale?
Yeah, and that gets at the heart of why we're here. It's a great question. And where we are today, really, all the technologies, all the announcements that have been made really amount to about 5% of the total demand. And as you pointed out, by 2050, several governments have a target either to get to 100% or at least the majority SAF being used, and we're at 5% today. The limitation is feedstocks, and it has been historically. So we started out with fats, oils, and greases. Honeywell was the original inventor of that technology. If you exhaust all the fats, oils, and greases that are available today, you might be able to get to 10% by our estimate of the total SAF requirement. We announced last October ethanol to jet, so you can use ethanol. That gets you another 10 to 15%, so now you're at 25%. We have woody biomass technology as well. You can get another 15% from that if you convert. But then ultimately, you need the abundant feedstock called carbon dioxide. That's the ultimate solution. That's really the only way you can get to that mass balance, to the long-term goal.
But in order to do that, you have to have an awful lot of renewable generating capacity to A, drive the carbon capture, and B, split the water. That's where the limiting factor appears to be when it comes to your technology. How much of a scale-up is going to be required to provide the energy feedstock effectively to make your technology work?
Yeah, it's a dramatic scale-up. So if you look at the technology that we're announcing now and the investment that's being announced with HIF this week, that represents 11,000 barrels. So it does represent a pretty small amount. So it's 0.15% of the total demand. So you need 6 of these for every 1%, 60 for every 10%. So you can scale the math from there. So it's a pretty significant number of these that are required. But again, the scale will get bigger, and then also the amount of renewable energy.
That was Lucien Bodea, Honeywell Performance Materials and Technology CEO. And Guy, it's all great to talk about. It's still very expensive to get all this stuff done.
You've got to scale it up. And scaling it up is really difficult. And providing the inputs to make that scaling up process work is really complicated and expensive and hard to do. So yeah, the chemistry sounds reasonably straightforward. but the scale isn't. And that's the challenge. And you and I constantly talk about this. How do you make the energy transition work? How do you make the energy transition work at an affordable price? How do you make the energy transition work at a profitable level? I don't think anybody's got clear answers to those yet.
What does really help, though, is the IRA here in the U.S., and that dramatically helps to bring the cost down for, say, e-jet fuel versus regular sustainable aviation fuel. However, if that's on the chopping block in any kind of capacity for the debt ceiling and budget negotiations, maybe that changes the game. A lot of people talk about the trains left the station, but can the train profitably leave the station? Anyway, much more on that part of the conversation. Coming up, Bruce Richards, Marathon Asset Management Chairman and CEO, will be joining us. Golden Age of Credit. This is Bloomberg. We're about an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. We had a little pop here after the CPI, but we're just not holding up on it.
Well, it's interesting because on the S&P 500, that's true. We're off the highs, up 1% at one point. But take a look at the NASDAQ 100. We're still seeing a nice lift there, up about 1%. And there's a little bit of a battle between, or beneath the surface, I should say. Microsoft and Amazon, two of those big mega cap tech names, in times of uncertainty considered to be safety, which is hard for me to accept in some ways, but that is certainly the market's assessment. Rivian Automotive, a great quarter. That stock up 10.6%. They also, it looks like the second half could see a production ramp. Airbnb, on the other hand, not so much. Now, their first quarter revenue of $1.82 billion, that represented 20% growth. That was their best first quarter ever, but it's the second quarter guide where they're looking at 12 to 16% growth. And this is the issue. So back in 2022, you can see that the revenue growth on the first quarter was 70%, really moving in the wrong direction, 20% there again for that first quarter, but let's call that midpoint of 14%. Investors not quite liking that. So those shares at one point, the worst day in that stock's Young Life IPOing back in December of 2020, right now down about 11%. But helping out big tech, we do of course have yields in after that inline CPI print. You can see the 2-year yield coming in about 8 basis points, the 10-year yield a little bit less, but nonetheless, even though this is a rally for bonds, suggesting that there is maybe a little bit of a haven bid, lower yields take some valuation pressure off the NASDAQ 100. That could in fact be the story going forward. Now we of course have so many factors of uncertainty, PPI coming out, the debt ceiling debate, but if yields continue to go lower as bonds go higher, even though it's a little bit counterintuitive, this RSI on the NASDAQ 100 looks like it is likely to shoot higher toward oversold. Were that to happen, that would suggest the NASDAQ 100 is going to go higher. So sort of a hard puzzle or difficult puzzle to wrap my brain around, at least, Alex. But again, if we do see uncertainty drive bonds higher, yields go lower, that could help out big tech.
Right, which is counterintuitive to then having some kind of debt ceiling debate there. Abigail, thanks very much. Really appreciate it. Abigail Doolittle joining us there. I want to get back to our question of the day. Did that inflation print actually change anything? Joining us now, Bruce Richards, Marathon Asset Management CIO. What do you think?
Well, I think the market participants came into the CPI number thinking the number would actually be much higher than what it was. And so when it came in where it was expected, the markets then rallied. And so did inflation change anything, the bigger picture? No, absolutely not. Inflation is still running close to 5%. And last time I checked, first quarter GDP came at 1.1%. And so we're moving towards this scenario of stagflation when we hit a recession later this year, because inflation is proven to be very, very sticky based upon wage growth and other measures of inflation.
Mm-hmm. Bruce, good morning. It's Guy. The markets tend to only focus on one thing at one particular time. Is the debt ceiling that thing right now? Is that where we should be focusing our attention rather than worrying about whether or not we get a small beat or a kind of miss on inflation?
Well, there's lots of things to consider, debt ceiling being one of them, but debt ceiling being a very immediate consideration, because June 1, as Janet Yellen's pointed out many times, is around the corner. I think she has a little bit more time than June 1, maybe to June 7th, and if they can make it June 15th, they're going to have a tax date from the corporate tax receipts, which may take them out to maybe July. But it's brinkmanship. It's a game of poker. Neither side is showing their hand right now. And I think it comes right down to the wire. And it becomes a little scary for the markets. That's why CDS is trading at 175 right now, 1-year CDS on U.S. Treasury default, which, by the way, shows to be a worse credit from a credit CDS perspective than where Saudi Arabia and Slovakia trade. And if it's equivalent to where Chile is trading right now. And so it's not a very good thing, I think, for our country to be going through this. And it's really a shame that they have to wait till the last minute, have this level of brinkmanship. And so will short-term treasuries maturing in the month of June trade at higher and higher rates? And might Treasury 10-year notes rally on this? Mm-hmm. For all these Treasury traders are out there that are kind of, positioning around the Treasury curve? Yeah, that's probably going to be the next move as you move into June.
Well, if you can get, 5+ yield, 5% plus yield on the short-term T-bills, do you buy that?
Yeah, I think you do. I mean,
do you buy the risk?
I think you do. I think you buy 540 bills, because I think they'll furlough furlough employees before they'll ever let the debt actually default. But it'll get to that scary moment, which will bring both sides and whenever you have a compromise, it'll be both will want to consider it a win, but both will have to consider major concessions to get that done, because I think the heels are dug in on both sides of the house here.
Do you short stocks in this scenario?
Stocks are really remarkable how well they are trading, but when you talk about stocks, you talk about the S&P 500, you talk about the NASDAQ, and we just talked about the NASDAQ 100 before I came on, and they're looking strong because there's a very few cohort of stocks that are driving those indices higher. And if you look at the Russell 2000, for instance, it's lower on the year. And so do you short stocks here? I think stocks are overvalued based upon their current PE and based upon a recession coming, and they're overvalued for two main reasons. Number one, I think the stock market is thinking the Fed is going to be easing later this year, and that's a wrong assumption in our estimation. I think the Fed will keep rates firm throughout the course of the year and won't ease until we're actually in a recession. number one. Number two, the stock market, I believe, is overvalued because it's expecting some soft landing or maybe no landing with 2% inflation at some point at the end of that horizon. And right now, I think the train has left the station. It's going to be a recession. I think every indication that we see is recession, and the stock market isn't banking on that. In fact, the stock market is banking on no recession and Fed easing. And so the stock market, if they're right about that, is right. And if they're wrong about that, we're going lower.
And that means it could be the golden age of credit. That is what you said to print. Oh, hold on a second. So Randy Schwimmer of Churchill Asset Management, he spoke to us yesterday, and we asked him about the golden age of credit. Are we entering that moment?
I wouldn't necessarily say golden age, but I would say that this is the best vintage that we have seen in quite a while, because look at where interest spreads are right now, all-in yields for senior secured debt, 12%, right? That's very attractive. And then the other thing is that structures and leverage have come down for borrowers right now, and so the leverage is lower, rates are higher, so that dynamic for institutional investors is very attractive.
So not like golden age, maybe good vintage, but Guy, I feel like we've heard that before, maybe not in the best context.
Yeah,
Go
ahead, Guy.
Okay. Bruce, the last time I heard somebody talking about this was Henry Kravis. 2007, it all went pretty wrong pretty quickly after that. You guys are getting paid, we just heard about it, you guys are getting paid pretty well right now. The question is there a danger that you're actually being underpaid rather than overpaid, and the risk is much greater than we all think?
Well, the brilliant Henry Kravis was wrong maybe a couple times in life. That's one of them. He's done a pretty good job in making his calls. Having said that, he was wrong about that because we saw what happened next in 08, 09. So where I disagree with that quote about being a good time, you know, and what was just said, you know, look, we're seeing credit metrics deteriorate, and we're seeing it in the fact that there are more downgrades and upgrades by a factor of more than 2 to 1, and we believe in our models and our analysis that number is going to 3 or 4 to 1, downgrades to upgrades among high yield cohorts, number one. Number two, default rates, which were basically non-existent a year ago and 2 years ago, are rising, and we believe the cumulative default rate will get to 10%. And so we think that there's going to be a big distress cycle coming, and a lot of the metrics that I think was just referred to are maybe slightly different than the vantage point that we're seeing, because we see a worsening credit cycle. And so what makes this the golden era of credit is very different. We'll see a 10% default rate before this is all done with, but we'll see 90% of the credits, therefore, not default. And if you're good at picking credits, good at building a portfolio of performing credits on the liquid side and making loans that have tight covenants, that have good credit metrics on good companies that will make it through, then you'll make the best returns we'll see in a generation. And so making a double-digit return on your private loans when the banks aren't lending is a beautiful thing to be doing. In addition to that, on the liquid credit side, between high-yield, leverage loans, structured credit, the various credit metrics that you can look at and credit segments that you can look at, we're making the highest rates of return in terms of both the coupon and cash flow, as well as what we think is going to be the ultimate IRR for those assets.
Bruce, if private credit is doing well, does that imply that private equity is not?
I think it's going to be a really interesting period of time, Guy, and that's a really interesting question that you posed there, because when you think about the base rate being zero a year ago, 2 years ago, 3 years ago, for years and years in this last generation, private equity was able to buy companies and finance really, really cheaply. Now you've gone from this LIBOR plus 5 to SOFR plus 5, and the difference between the funding cost is the difference between the private credit manager earning a 5% yield and now the private credit manager, in that example, yielding a 10% yield. And so we're earning twice the return for the same element of risk. And that comes out of whose pocket? It comes out of private equity, or the company's pocket. Private equity owns that company, who now has to pay that much higher cost. And so there's actually a little bit of a wealth transfer going on. We don't think about it that way, but I'll just say it, where the companies are going to pay a lot more for financing their debt than they have in the last generation, being the last decade plus. And so what makes it the golden era of credit, Alex? It's because we're earning such a great rate of return per unit of risk. And who's it at the expense of? Well, the folks that are leveraged, that have borrowed at these lower rates, now have to pay a higher rate. And I remind all the viewers that when I went back just yesterday and looked at the last 60 years of data, what was the average day count of Fed funds rate over this last 60 years? The average to the second decimal is 5.00. Fed funds are 5 today, and the average for the last 60 years has been 5. So what muscle memory is for recent times of we only pay 1 or 2% on these base rates may be ill-conceived for this next period of time, as we're now back to the average, and we have inflation, and the Fed's going to remain firm for longer.
Yep, an average that we haven't seen in a really long time, as you point out. Bruce, good to catch up with you. Always fun. Bruce Richards, Marathon Asset Management CEO. Thank you so much. Coming up, auditing China-based companies that list on U.S. stock exchanges. Is it working? Does it work? We're going to take a look at the chair of the body that's looking into this transparency compliance. Erica Williams of the Public Company Accounting Oversight Board joins us next. This is Bloomberg. Chinese stocks listed in the U.S. might not always be a sure thing. So the U.S. is now inspecting Chinese and Hong Kong auditors of U.S.-listed firms to see if they can, in fact, stay publicly listed. Now, a new report by the Public Company Accounting Oversight Board shows there is a very long way to go. So joining us in an exclusive interview is Erica Williams, chair of the PCAOB, who is leading the investigation. What did you find in this report in terms of the auditors of U.S. Chinese companies listed in the U.S.?
Thanks for that question, and thanks for having me. So if we take a step back and think about how we got here, the PCAOB is 20 years old, and we've been able to inspect and investigate audit firms in 50 jurisdictions around the world, but we hadn't been able to inspect and investigate in China until Congress in 2020 passed the Holding Foreign Companies Accountable Act, which gave us for the first time leverage to be able to inspect and investigate in China and Hong Kong. And today we released reports that show the results of our inspections from last year. And as you know, we did uncover a number of deficiencies, and it is an opportunity now for us to hold firms accountable to fix those problems.
Erica, good morning. It's Guy in London. Can you just talk me through what you found in terms of the audits that you went through? Were these audits that were being done by Western companies? Were these Chinese audits that were being done? Can you give a bit more granularity on what you found and who those responsible for any failure, who was responsible for any failures that you did discover and uncover?
Sure. So we inspected 8 audit firms in China and Hong Kong, 4 that were based in China and 4 in we inspected 2 firms, 1 in China and 1 in Hong Kong, and we inspected 4 engagements, which is companies in each of those audit firms. We did find significant deficiencies. It is similar and consistent with the types of deficiencies we found in inspections for other audit firms that have been inspected for the very first time. And what we've seen is in many instances those improve over years. What we do know about this is that these firms that we inspected covered 40% of the U.S. Market share of companies that were audited by China and Hong Kong firms. And by the end of this year, we will have inspected the audit firms that cover 99% market share. So we looked at the most significant companies that were audited by these China and Hong Kong-based firms.
So Erica, if I'm a U.S. investor and I'm invested in some of these companies that are U.S. listed, should I sell them? Like, are you guys going to kick them off the exchange? When am I going to know that?
So this, what we have under the Holding Foreign Companies Accountable Act is a responsibility to inspect and investigate completely. And then we put out these reports and shine a light on what we found so that investors have information in order to make investment decisions and also to put pressure on the firms to improve. Our job is not as to whether or not these companies could continue to be listed, but it really is to give investors important information and to provide transparency, which is what we're doing in these reports.
Erica, how did the process work? Was it easy? Did you get what you needed? Did you have to fight for any of the details that were included in these audits? This was meant to be a kind of open book look at what is happening here. Was it that?
Yes, so last year we entered into an agreement with the PRC, and it was a tough agreement. And under it, we needed to be able to inspect and investigate completely. We needed to be able to choose the engagements and the firms that we inspect. We needed to have access to all of the work papers and the personnel, and we also needed to be able to conduct our investigations without interference. And we were able to do that. We were tough and we were firm, and we obtained the information that we need and did have complete access. And if the PRC instructs us in any way in our investigations or in our inspections going forward, the board will not hesitate to act immediately and consider whether or not we need to make another determination with respect to China and Hong Kong.
Erica, tough work. We appreciate you doing it. Thank you very much indeed for joining us and telling us what's going on. We'll look forward to seeing you At the next report, Erica Williams, chair of the Public Company Accounting Oversight Board. Thank you very much indeed. Coming up, Google's offering to compete against ChatGPT. We're going to go live to Google's I/O conference. It is taking place in Mountain View, California. The startup is next. This is Bloomberg. Just leaning over to look at the clock, 52 minutes past 7 on the West Coast. We're a little late, but California's up and running. It's time for the startup. Top tech stories from the Bay Area and beyond. We're very much of the beyond at the moment. Joining us now, Bloomberg Technology co-host Ed Ludlow. Mountain View, California is the location today. The event, the Google I/O conference. Ed, I'm assuming there's a lot of AI talk at this conference and how Google is going to compete.
AI is everything here, and the expectation is that Google will give us a more conversational AI-powered version of search. And it's a really interesting moment because, yes, they released Bard in February, the generative AI tool, the ChatGPT-like tool, but they've always billed it as a companion to Google Search rather than a replacement. So what we want to know is how they integrate the development of their large language models into the core search product. And, you know, this is framed by investors, by AI enthusiasts, by technologists as make or break, right? Because it is Google's to lose, having led the way in this field for many years.
Mm-hmm. So how much pressure then is Google under to like flex its AI muscles?
Yeah, you know, we discussed on the startup, right? When Bard first came out, 48 hours after its release, an inaccuracy was noticed, and that had a profound impact on the stock during that day's session. They've always led in research, R&D, development of large language models. They lost first mover advantage in this year to Microsoft, who moved quickly to integrate OpenAI's technology, both on the enterprise and consumer-facing side with Bing. So that's what we want to see. What are the products here? How does it go into their software and devices offering? Devices also key, a small market for Alphabet, but one that they want to grow.
And then quickly with devices that you just mentioned, are we going to see anything exciting here on that?
Yeah, Pixel Fold. And a folding phone goes right to the AI story. A much bigger screen, higher processing power. That directly relates to the inference part of generative AI. What use cases could a larger folding phone with a strong processor bring us if the LLMs or the generative AI tools are embedded within it? That's a really key conversation here, and there's optimism that this might move the marker a little bit for Google and where it sits as a very small player in global devices.
Hey, Ed, awesome stuff. You're like in your own zone right now, and we appreciate it. Ed Ludlow joining us. And tune in for an exclusive conversation with Rick Osterloh, Google's SVP of Devices and Services, coming up. Guy?
Absolutely. Very much looking forward to that conversation. Ed was saying that everybody walks around that campus going, "Hey Google," and that's the joke. They refer to each other as "Hey Google." Anyway, talking of markets, I know it's Stock 600 down a little bit, down by around 0.5%. It does seem as if this post-CPI move is beginning to fade and fade quite quickly. The euro, the dollar was down after the CPI prints. That move again fading fairly quickly. The euro dollar basically back to flat. We're back to the sub 109, sub 110 position, 109.67. The corporate reporting season continues. We should probably continue to talk about it. Therefore, Credit Agricole up by 5.24%. Did really well in FIC. Fixed income. Absolutely blowing it out of the park, and that's really interesting. European banks continue to do relatively well. The key question now is, where should you be investing your money? Is it time to move out of Europe? And does that include the UK? We're going to talk about that next. Sharon Bell of Goldman Sachs is going to be joining us. Looking forward to having that conversation. Sterling certainly has been on a tear recently. Does that translate into other UK assets? We're going to find out next. This is Bloomberg.